Hi guys, welcome to the sixth and final episode of the You and Your Money Show. Today we're talking about investing. An investment is something that you purchase hoping that it will generate income for you or increase in value. This could be land, seeds, animals for a poultry or fishery. It could also be jewelry. As long as it can be used to generate future income, it can be classed as an investment. Investments can be short-term, like up to 2 years to get your money, such as when you're farming, or medium-term, 2 to 5 years to get your money back, like when you buy shares in a company. Or it could be long-term, which is 5 years plus. And we're talking about things like buying property, buying land, or starting a business. It could take up to 5 years for you to start getting your money back from that investment. The most popular types are starting a business. When you invest in starting a business, you might be buying equipment, land, and raw materials, hoping that in future, when you're able to sell your products or your services, you can make money from the business. Another popular one is farming. People buy land and farm, or they start up a poultry, piggery, fishery, hoping that the money that they spend on building that business will yield them back a return when they sell the produce from their farm. Most people invest in property if they have the money, and this could be land or a building. Property investments are long-term investments because it usually takes between 5 to 10 years for the value of the property to rise. Other forms of investments are government securities, and that's when you loan the government money. So you give money to the government for 3, 6, or 12 months, and when they pay you back, they'll pay you back with a little bit of interest. The same thing goes for bonds, where you can also buy from a company and get the money back in interest. And talking about companies, you could buy shares in a company. A share in a company is simply buying a part of the company. When you buy their shares, if the company makes money, you make money. But if the company loses money, you also can lose money. Shares can also be called stocks. And then you've got mutual funds as a way to invest. A mutual fund is where money from people who are investing, and those people are called investors, where money from investors is pulled together and used to buy a mixture of different types of investments. A mutual fund can buy treasury bills or government securities. They could buy shares and bonds. And the reason they do this is because if one asset fails, another one might succeed, and that is a mutual fund. Every investment comes with risk. You might increase your money, but you could also lose your money. But each investment has a different level of risk. So choose the investment that suits your risk appetite. Property might not be as risky because you can convert your property into an office, you could rent it out, you could do many things with property that stop it being a risk. However, if the property market crashes, the value of your house can crash as well. Some people believe that it's better to buy shares in companies. However, if the shares price crash, yours crash as well. With farming, you could have something like bird flu affecting your poultry. So regardless of what you choose, every single investment comes with a level of risk. So you must be sure that you can manage the risk before you choose the investment. Some of the benefits of investment include you get more money, your income grows. If you purchase property, you have ownership of the property, which you can use in future as collateral or security. Investments also help you secure a more financially stable retirement, because if you have money coming in from an investment for the rest of your life, even when you're not working, you get an income. And investments in terms of starting a business can create goods, products, and employment, which is beneficial for all of us. But remember, you have to invest wisely. If it's too good to be true, it probably is. So no money doubling or pyramid schemes. Those are not investments. Don't invest your money in a company that claims investments if they are not registered with the Securities and Exchange Commission, SEC, and if they're a financial company, they need to be registered with the Central Bank of Nigeria. A company having a CAC registration, which is the Corporate Affairs Commission, doesn't mean that they are a legitimate investment company. It only means that the company name has been registered, but it doesn't mean they're being regulated in their financial dealings. So if it's an investment house, it needs to have a Security and Exchange Commission license to operate. And if it's a finance house, it needs to have a Central Bank of Nigeria license to operate. Those two organizations regulate the way that finance and investment houses are run, making sure your money and your investment is safe. Only invest after you're comfortable with the level of risk that comes with your investment. Try and diversify so that you don't put all your eggs in one basket. And if it's a long-term investment, be sure you won't need the money in the short term. And only ever invest in a business that you understand and in a business that has products or services. That's all for today's show, folks. It's your girl, Infinite Ngozi, bringing you another episode of You and Your Money, sponsored by the Bankers Committee. Bye, Committee.